Hey friends, it's been quite an interesting week in the mortgage rate world. So last week, the Federal Reserve hiked interest rates by 25 basis points. We knew that was going to happen, and that didn't have any effect on mortgage rates. But what they did say is that all future rate hikes would be data dependent. Now, we know they're getting close to the end of the rate hike cycle. In order for rates to go down, they need to say that they're at the end. But the very next day, we had inflation data that was all hotter than expected. Then the news this week, some was better, some was worse, but rates just continued to move higher until today, when the Bureau of Labor Statistics number came out, the BLS number that usually comes out on the first Friday of every month. That's not a Friday. Those numbers were slightly cooler than expected, and mortgage rates are starting to recover some. But we're sitting right now at close to 23-year highs. Now, that sounds terrible, and when you compare it to the last 23 years, it is. But when you compare it historically to where rates are, it's not too bad. This is also, we're nearing the end of the interest rate hiking cycle. In the next couple of years, rates are going to come down substantially. We're going to see rates with a 5 handle on them in the not too distant future. And when I say 5 handle, I mean 5 point something is what the rate will be. So I'll keep you aware of everything else going on. Next, I believe Thursday, don't quote me on the day, but I believe Thursday is the Consumer Price Index. And I will have some interesting updates, hopefully good news for you. We're hoping for low inflation. We're hoping for low inflation for you, your pocketbook, the things that you're buying, and for mortgage rates as well too. Again, I'm Zalmanoff. Peace out, friends.